All right, we are back. The AppliedMMT live stream back with Ty. How you doing, man?
Oh, I'm doing wonderful. I got my light here. Comments on the light are more than appreciated. I think it's a good thing. Some people don't think it's a good thing. We're sticking with it for now.
I'm glad you pointed out the light, Ty, because had you not pointed it out, I don't think the viewers would have noticed. Um, all right, we're back. Chat. Welcome back, Ozzy. Thanks for jumping in, being the first in, man. Good to see you back. It's been a while. This is season 5. Season 4 was very short, cut short by a writer's strike. But we're back, and while we've been gone, it's been a while since we've streamed, but while we've been gone, I think a few things have happened in the world of macroeconomics in markets that we need to talk about. And what I really want to do tonight is discuss what's on the docket for the macroeconomy into the future. Is there a bull case to be made despite all the chaos that has been ongoing? That's what we're going to discuss tonight. Chat, if you are here, man, make sure you say hi. And oh yeah, and if you hit that like button, all that good stuff too. Get subscribed if you are new here. Let's see. I mean, I think we should maybe set the stage. What I'm going to do is just jump right on over to markets. I think the last time we streamed was at the beginning of the year. I think one of the things we did discuss in that last stream was just how bearish the potential was for tariffs when the tariffs finally kicked in. Obviously, markets priced in a ton of chaos immediately. And one of the other things we said also, and it might have been the last stream, Ty, maybe it was when you and I were talking things through just kind of offline, but one of the things that you had said was the worst case scenario right now from just a pure system dynamic standpoint would be another shock. And lo and behold, I would say what we got was another shock, maybe not on par with COVID, but the reason you said that another shock would be a little bad timing right now was we are just literally getting back to a normal business cycle in the sense of we were starting to see the normal causal effect play out and just growth emerge endogenously through money creation, all that sort of stuff that you expect in a business cycle play out for the first time since pre-COVID. And that a shock to a system that is not, I use the term equilibrium here, not to mean what what our neoclassical friends would mean as equilibrium, but we were finally getting back to an equilibrium of just kind of a normal business cycle. And in a system dynamic that is coming back into normal parameters, when you shock that after it is faced one shock prior, the chaos that can emerge is quite extensive. So I don't know if you remember that comment, but if you do, can you kind of wax poetically on why that's important in a system dynamic standpoint to, in terms of just using a system dynamic perspective to forecast why shocks on tops of shocks can lead to what we're seeing?
Yeah, so if we kind of simplify a model of some sort, any dynamic model, you can picture it maybe being oscillatory. So, standard, oscillations, right? And COVID, of course, introduced a major oscillation, and we, in that pattern, a lot of variables in the system, whether it was unemployment, profits, right, dropped way down, shot back up, started dropping back down, shot back up, and then slowly kind of went back into an equilibrium oscillation, around some hypothetical equilibrium. COVID really, and if we look at the data, it kind of persisted that shock, that extreme oscillation to many different variables that are counter oscillating, right? And I'm just speaking hypothetically, right? That lasted like 12 quarters, so 3 years, right? And we're just, through 2023, we're starting to peter out and return to kind of normal dynamics. And now, of course, Trump has introduced his own set of shocks, right? When the system isn't quite back to that normal stability. So you're stacking shocks upon shocks, right? And you have no idea how that's going to affect the system, right? Look at like wave dynamics, and I hate to kind of get like really pie in the sky tin hat stuff here, but if you look at wave dynamics, right, you can have a normal wave happen, and then you can intersect it with another wave. And sometimes, depending on the initial conditions and the parameters, those two waves get canceled out. Or those two waves intersect and they make a huge super wave. And people in the shipping industry, I forget what they call it, but these waves can be deadly to ships, right? You can't predict these waves at all, right? Because it's part of a nonlinear complex system, right? So that's a danger of, dealing with the COVID shock, which was kind of necessary, shutting down the economy, right? Trying to protect people's lives. That still was kind of happening and still is, although I think, we're very close to returning to a more normal, stable economy. And then Trump jumps in with his tariff rhetoric and, all his other economic policies, introducing that new shock. And how do those two waves intersect, right? And I'm speaking very generalized from a system dynamic perspective. I'm not talking about specific variables, but as we dig deeper into this, then we can start applying that to specific variables.
Yeah. Okay. So that was helpful just to get us, kind of on the same page, on the right page, kind of where we're at, catching up. We're post-COVID shock without a doubt. But right on the tail end of it, and now we have this new shock where things were just finally stabilizing, and already we've seen some good questions in chat, getting at the right idea, which is, what's going to happen with the tariffs with regards to shortages of goods, with the potential supply chain impact. How does that then impact potential investment? And I think that whole track is the bear case. And the bear case is, and I'm gonna phrase this that we're not dealing with neoclassical economists who don't understand how markets work in the first place. We'll at least couch this in the post-Keynesian MMT framework of, at the very least, the both the income generated from government spending and the additional income generated from the normal business cycle of credit creation. Within that framework of that driving future expectations, what ends up playing out from there, particularly from that credit side of things. And I think the most reasonable bear case is exactly what Sly is saying, that there's going to be this uncertainty that's going to just lead to a cutback in credit expansion. And Sly, if I don't come back to that in just a second, I will, in terms of giving the counterexample, or remind me. But the thought there is that businesses will just start to shut down because they don't have the slightest clue what the future is going to bring. And to a certain extent, we are, from one vantage point, we are kind of seeing that. And I saw earlier today the Dallas Fed manufacturing outlook came out, and it's not looking good. I mean, it's looking like a COVID shock. And to a certain extent, we saw this play out on multiple levels. We saw imports shoot up right after in March and April for the immediate aftermath of the tariff announcement, which obviously caved GDP to negative levels on the GDP nowcast. So we saw that. We anticipated, and I'm sure every single person can give some sort of anecdote of someone around them that saw projects hit pause on a project, dismantle various projects, dismantle hiring. So I'm sure we might see a pretty wonky employment number come out as well, maybe new hirings down, that sort of thing. So there's going to be this immediate shock, and the question is, will this reverberate into a lack of new credit creation? And that is the bear case. And Ty, I think it's fair to say that's a very reasonable case to be made, right? It's not like in 2022 when everyone was saying higher rates are going to crash the economy, and they're completely missing the whole idea of this additional interest income that's coming in, right? Like, this is we can't fault it on its own merit. This is something that could play out because you're dealing with essentially autonomous agents who could ultimately follow through with that logic. Is that fair?
Yeah, I think if you kind of dial it back and look at corporate and non-corporate profits, right, and what are they going to be, come the end of this quarter, That's going to kind of dictate investment, right? Which is going to dictate manufacturing. And we're already seeing manufacturing. That's pretty high frequency data. I think you were saying that's monthly, right? We're already seeing that dip off, which indicates we're already seeing a decline in gross investment. With those things kind of added up and outputs going down, you've got employment going down. So you're kind of seeing a trend to the bearish side of things, right? Ultimately, it's a cycle, and one day, that employment going down is going to be a good thing, right? It's going to lower costs for corporations and firms, and we'll see a boom in the future. But for now, it would be a fair assessment to describe that as kind of a bear situation going forward.
So the question is, and then where we're going to go from here is, what is the bull case then in the face of all of this? And if, to put my cards on the table, that is still where I'm at. Is I think ultimately we're going to recover. And I really think there's a very good case that what is going to play out is a similarity between, say, 1998, maybe 2005, something similar to that. If I'm going back further in my mind, like post 87, after that into early 91, which is really just going to be a big credit boom, actually. And here's how I'm getting there. And again, I want to, respect, if you will, the bear argument, but then also give the bullish case here and say that for the argument that uncertainty causes a pause in terms of investment. Let's actually take a step back, because this is important that we get this. That the reason markets go higher over time is because growth expectations increase, and the reason markets particularly shoot much higher relative to trend is because you end up seeing profit expectations higher than expected. And the reason that happens, like profit expectations come in higher than expected. And the reason that happens is because companies, when they anticipate higher demand and higher profits, they invest, and they invest more. And the very act of investing creates the necessary income to then support the higher earnings, the higher profits, which then drives higher investment. And this is kind of Minsky 101. And this is at the heart of our entire analysis that we do. This is how things drive. This is how the macroeconomy will drive growth forward, will drive returns higher into the future. And with that idea in mind, that uncertainty could pause the investment that would drive, because it's that investment, it's creating the new loan that's going to create the new money that's going to push things higher, is to me a micro argument that doesn't necessarily apply on a macro level. And what I mean by that is, I agree there are going to be a lot of companies, particularly companies clearly in manufacturing, that are going to say, whoa, we're hitting the pause on potential and future investments, right? But what that always does is, and this is the exact same thing, this is the exact same miss that people had with interest rates. When interest rates get pushed higher, it is just selecting a new winner and loser. It is not necessarily collapsing the entire macroeconomy. It's just selecting new winners and new losers. And this policy change that we've seen with Trump, and at the end of the day too, and George Robertson makes this case, I mean, it looks like this is all just going to fizzle anyway, that Trump's going to lose over and over again in the courts. We're already seeing multiple lawsuits with the tariffs. He already is realizing this was a big mistake. He's walked it back, walked it forward, walked it back, walked it forward. Right now, I think we're walking it back, maybe stepping it forward just a little bit. That ultimately the worst of the tariffs is going to materialize anyway. And eventually, corporate America is just going to take over, right? They're just going to steer the ship, if you will, and say, no, this is just, Trump, you actually can't do this. At the end of the day, to a certain extent, the fact that corporate America is so massive, I think they end up taking over. And if that's the case, there will be companies that will see this as an opportunity to take risk. And that is what's most important, at least from the kind of micro assessment, the agent specific assessment, is you might get large companies, small companies, companies that say, no, we cannot risk taking out a loan here, but that always means that there's someone, if the income is available, if the profit expectation is available at the macro scale, there's someone else who's willing to take that on, who's willing to take on that risk. And all it takes is someone who's willing to take on that risk when someone else isn't, that at the macro scale, it levels out to more investment relative to what would have been. And as it stands right now, that's what we're seeing in the data, despite the chaos. And what's even like more important, not more important, but just follows on top of this, is when you do get these big mispricings that happen. We saw this in COVID. Now, obviously, the COVID situation is different, where we got an immediate injection of the stimmy checks right away. I think Trump shut the economy down at the end of March, and by the end of April, we were all getting, I think, our first wave of stimmy checks. That's probably not going to happen, but you get this massive bullwhip effect where when things get priced in so incorrectly one direction, the snapback move can oftentimes start the momentum to just put the rally higher. And so I think there is a very good chance that is what will end up playing out, and definitely what I remain leaning towards. And I'll show just a couple data points to really drive that home. The first is, and I've been posting this on Twitter from time to time, the first is just the Trump spending relative to last year. And again, if you recall, when we did our last stream or two, we had said, our forecast into the future for spending is effectively unchanged from the year prior. Maybe slightly lower is what we were forecasting just endogenously. Obviously, Trump's come in and shaken a lot of things up. But as it stands right now, spending is exactly where we thought it would be this year. We are exactly in line with last year, effectively unchanged from a year prior. And so, look, spending is tremendously high. We are still growing quite a lot. In terms of spending, inflation has remained relatively flat. If you look at spending from an inflation-adjusted perspective, still no concern here. Now, I do think this can start to become a concern, and might become a concern depending on what ends up playing out with the tax cuts. But for now, spending is completely fine. So the next question is, it's at a necessary level to continue growth. The next question is, what are we seeing on the bank's balance sheets? And we are seeing, and I think I mentioned this in my most recent video, we are seeing just a massive acceleration on the credit side of things. And to me, this is enough. I mean, this data is 1 week delayed. So it updated on the 25th, but it was for the week prior, ending the week prior on the bank's balance sheet. So it's had enough time to update for tariff considerations to be made. And we just continue to see credit expansion explode here. I mean, we're looking at loans and leases, but across the board on the bank's balance sheets, we're seeing credit expansion occur here. And so to me, it's showing me that the idea of people still willing to take risk here makes sense. And that's kind of what we're seeing. I don't know if you had any thoughts specifically on that, or even any pushback too. I mean, this is admittedly one of the trickier spots I've ever seen markets in.
Yeah, no, where I agree, obviously, the Trump factor, right? So if he isn't able to push through his vision, hopefully he can't, right? That's going to, right now, profit expectations are relatively low, right? That's going to cause a huge boost in profit expectations. And of course, just expectations of profits can be like self-reinforcing. So you actually, ultimately down the road, you actually have realized profits, right? And if you look at, macroeconomics, what's the main driver of, capital investment? It's your profits, right? So it could cause a huge rally in the economy, right? And if that's the case, then of course that's going to be supported either by or both by fiscal and credit expansion, right? And we can see that. Now, to counter that argument, right now that credit expansion could be because of difficulties in the household sector, right? So it is accelerating right now, but we're not too sure why. We're going to need more data going into the future. It could just be a little blip, right? So, but it is interesting to see it rise. It's saying something that's counterintuitive to what we're seeing in other parts of the data, right? That's rising credit. So it's something that I know Doug's going to watch. I'm going to watch, right? What is it, right? What's coming out of it? Now, in general, macroeconomic terms, a rising credit's actually good, right? That's a sign of economic activity. People are taking out loans. It's important, but it could be a sign of something else too, where people are needing to take out credit because their needs aren't being met with income, both for, let's say, firms, payrolls, et cetera, or households, right? Reoccurring debt, et cetera. So it'll be interesting to watch it. That's the one part where maybe I'd broach the conversation. We need to watch that a little longer and see where it goes. But generally, like if we go back to the beginning, a lot of what's going to happen next is going to depend on what Trump can achieve in his policy options, right? And it's looking pretty apparent at this point that he's pushed hard and always has to back down. And that kind of bodes well going forward, right? If people find, like Doug was saying, if corporate America finally says, you know what, this guy's off his rocker, we're going to go do business, right? And that's going to cause an instant rise in profit expectations, and it could be the makings of a boom. But the factor is Trump, so that's kind of my opinion on it.
Also, in this vein too. And to me, there's a big wild card right here is, and I saw his tweet today. I can zoom in on this. I don't know how clear this is showing on the stream, but that Scott Bessent told Republicans that they're going to sketch out the plan to pass some tax cuts in the coming weeks. As polling shows, voters largely disapprove of how the White House has handled the economy. So the tax cuts are going to be huge in the sense of not like big for the economy per se, but in terms of understanding where the narrative is going to end up being. If the tax cuts go through to the extent that the Trump administration wants them to go through, and it's not, there's no, I mean, at the end of the day too, the vast majority of spending is non-discretionary and would be very, very difficult to cut politically. I mean, it's clear that the Trump administration has floated out some ideas about cutting things. And I think actually there will be some spending cuts in Medicare and spending other healthcare provisions. But when it comes to, the tax cuts, it looks like those are going to offset any spending cuts on the government services. And the implication of that is at the macro level, it doesn't matter. It really doesn't matter at the macro level if spending is on healthcare or if spending is just a removal of taxes, net spending wise. It is all income for the private sector at the macro level. Granted, you could say if we dial it back, just to kind of have this argument for a second, if you dial it back to say the COVID stimmy checks, yeah, I would agree that the outcome of something like a direct stimulus check, whether that's Social Security or whether that's, and by that I just mean, Social Security goes out, that is a direct payment, cash payment with no offsetting asset that's coming back to the government. In other words, it's not removing anything from the private sector into the government sector. It's just a direct payment. So very similar to the stimmies. When those things go out, those are going to have a different effect at the micro scale than something like the government provisioning themselves with some sort of tank or something like that. But either way, at the macro level, that's just going to be more income that remains out in the private sector when it's all said and done. And again, it's important to understand too. I mean, the government spends $6.5 trillion every year, and it takes back $5 trillion of that in taxes and other forms of revenue. And so the vast majority of that $6.5 trillion that it spends every year, again, is not discretionary. It would be very, very difficult to cut. So when you're doing tax cuts, what you're doing is you're just removing the amount the government takes back in. And there's a lot that the government takes back in. And so you could do a massive stimulus. And this ties back to the idea that this is very similar. I think someone said this in chat earlier. This is kind of similar to COVID. It's actually very similar to COVID, where you have a president come in, shut down the global economy, yell at policymakers for the decisions he made to do, cause a bunch of chaos, start to walk it back, and then put in a massive stimulus after all the chaos is settled. We don't have to look that far back into history to see how this played out. And again, I realize this might not be as inflationary of a move as a direct stimulus check might have been after a global shutdown, but effectively, very close. It's very, very close. And so you put all this together, and it's really hard for me to just not see that what we were forecasting at the end of last year and the start of this year was, before Trump came into office and followed through all the way with the tariffs, is we were looking for higher than expected growth heading into, essentially throughout 2025. So growth was going to be expectations by the end of 2025. And by the end of 2025, we were going to start to see inflation tick higher. Right now, obviously Trump threw an absolute wrench into the system with the immediate tariff chaos, but I still think there's a really good case to be made that by the end of 2025, we see both growth and then ultimately, as we get to the end of 2025, maybe early 2026, inflation expectations really start to push higher, and that might be the big surprise by the end of 2025 into 2026, is if this package gets passed and we do just end up seeing a lot more spending when it's all said and done, and you see a global economy that shut down, effectively, kind of warehoused, if you will, a pent-up demand for products, and now it's going to unleash those products. There's new income that we're seeing being created, both via endogenous money creation and then continued income flows from the government sector. You're set up to have the bullwhip effect that we saw back in COVID. And so it's not going to be one-to-one, but it could very much end up playing out similar to COVID, and depending on how the tax and spending plays out, you could very well see, if the spending isn't tremendous gain, but maybe a moderate gain, you could see maybe 2 years down the line where government spending is really starting to flatline, right, as we're hitting a peak in a massive credit expansion. And at that point in time, we could really end up seeing maybe the end of the business cycle around, say, 2027, 2028 range, assuming things, play out policy-wise, as I had explained right here. So that is my bull case. The bull case here really boils down to the idea that on a micro scale, yes, there are some that are going to pull back, not invest, and the implication of that is lower income when investment doesn't happen. However, my argument is there will always be someone who's willing to take that risk. And I think as of right now, we're seeing that play out. And Ty, I'll let you get a word in here in just a second. The counter to that, and I can already hear it coming from, some in my camp are going to be, but banks have to be willing to create those loans. And if banks don't want to create those loans, then that too can shut it down. Just because someone wants to take the risk, business or something like that wants to take the risk, doesn't mean the bank has to accommodate that risk. And so my counter to that is, well, we are still in a high rate environment, and in a high rate environment, it benefits banks to take risks in that high rate environment. And on top of that, just like some agents aren't going to want to take risk in terms of their business operations, and some will, there are going to be some banks that aren't going to want to take risk, but some are also willing to. And again, we're continuing to see that in the data. And so I see the opportunity I just see the opportunity for a credit boom here to still emerge. And that would be the bull case. Obviously, we'll continue to watch the data roll in, but that is how that is the bullish case as of right now, and certainly where I remain moderately lean towards more than I certainly. I mean, again, I think what has played out, back at the mid-April when we were at the absolute lowest, I was saying in the AppliedMMT updates that I have, that I think this is the biggest mispricing that we've seen since COVID, or really, and you have to go back a ways to get a mispricing as big as that. I still think this was a massive mispricing and have been positioning myself as such. So that is my bull case for the remainder of the year. I don't know if you have any thoughts on that, Ty. Go for it. Yeah.
Yeah, no, I completely actually agree on the banking, especially in the United States. So, hopefully most viewers know I come from Canada. We have 6 banks up here, essentially. We have credit unions too. Down in the States, you have 7,000, 8,000 different brands of banks. So if one bank says, no, I don't want to take that risk, that's a profit opportunity for another bank. So the banking sector in aggregate in the United States will always provide the credit. There will always be that bank out there, right? And of course, that just is a self-reinforcing feedback loop. That means if some alternative bank is going to provide the credit, then the big bank is going to provide the credit to get that business, right? So ultimately, the banks are in the business of providing credit, and they're always going to do it, no matter what the risk level. It might adjust things a bit, but the business is always going to be provided to non-financial firms to take those risks, right? So I could completely agree. In aggregate, there's firms are going to see opportunities out there and take it, right? So in that respect, that's a bull case scenario that's very plausible. It's not unrealistic. But I guess it really, at this point, I keep going back to Trump, like, he can do a complete reversal and give up on, whatever he was doing over the last 3 months. Or he can do the back and forth thing, which is what I really suspect is going to happen for the next 3.5 years. He puts out an outrageous policy, walks it to the very edge of the cliff, the abyss, and then walks it back. And a month later, he does it again, right? And that's going to be hard to really estimate how, corporate America reacts to that. Does corporate America, like Doug was saying, well, you know what, we're just going to take, we're going to take this by the bulls of the horn and we're just going to carry on. Well, another way they can do that is just say, well, this guy's got an expiration date. If, constitutionally, we hope. And we can just wait this out for 3.5 years and we'll just keep things going. And that can be fine for America for 3.5 years. It's not going to spell, a lot of big growth in the next few years, but they can just hold off. But that does mean that there's going to be a lot of pent-up demand come towards the latter parts of Trump's presidency.
Yeah.
Right? So there's really, he is the exogenous variable for America right now, for America's, economy. He is the exogenous variable. You can't model that guy. There's no way I could ever build a dynamic model of Donald Trump. If I could, I'd be rich. I'd already be on a yacht. But you can't. So it's just he's going to do some random stuff for the next 3.5 years. Some's going to be bad, which is his policies generally. And the good is when he walks back those policies. So we're just going to see an ebb and flow of bad and good for the next couple of years. And I would suggest, corporate America, the executives in the boardrooms will catch on to that and say, okay, let's just hold our fort for the next 3.5 years and just, let's keep, our projects on deck, but just hold off a little bit. They're not going to, start laying off massive amounts of people. They know the economy still needs to go, but we're just not going to see that big push. So that could be another scenario, right? So let's just watch Trump in that regard.
What is interesting, though, and you mentioned, for America, is I also think, too, for the first time in a very long time, and I mean, in my opinion, I think it's just good for the global economy as a whole, but I think we could really see a decoupling of the rest of the world's dependence on the U.S. to lead growth. And the implication of that is, particularly, I've mentioned this a lot in my updates recently, but early on in the year, even before the tariff stuff started, I've never diversified outside of the U.S., but I thought there was a really good argument to be made even before it happened, the tariff stuff that actually moving outside of the U.S. or moving into really the sort of assets that have been crushed over the last 15 years makes a lot of sense, particularly with the higher interest rates and there's the likelihood that we're finally going to see a credit boom bubble type scenario end up emerging. And now even more so, I think a potential scenario like that could end up playing out. And what you could easily end up seeing is a reversal of what's played out over the last 15 years where Europe has to lead the way in terms of spending. Obviously, we're seeing China take some aggressive stances. I don't follow China as closely as I kind of do Europe in terms of what their spending is looking like, but we are seeing Europe wanting to spend at this point, in part just because they have an existential threat right next door, and austerity is never going to win a war or get in the way of a war from occurring. And so it looks like there's an end to austerity. And so if Europe's willing to grow and the rest of the world is willing to grow, that in and of itself could also pop off a credit boom in the U.S. because the U.S. has to keep up. U.S. companies have to keep up. Now, obviously, Europe has decimated themselves over the last 15, 20 years with their austerity. They are, not at all what they used to be in terms of the technological prowess that they might have had at the beginning of the 21st century. And from manufacturing, I know they still manufacture a lot, but nothing like what they used to be. And it will take some time to build back up. But that doesn't matter if the investment starts. That kicks off the business cycle, and that forces the U.S. companies to also do the same thing. And my argument is the money's there, the potential is there to kick that business cycle off here still. So keep an eye on the rest of the world. I think the rest of the world plays a key role in this, and it'll be good. I mean, it'll just be good for everyone if the entire world can stop. And I don't mean this in like the outcome is better if everyone is investing for growth, right? Like the outcome is better for everyone once the trade stuff levels out and all that sort of stuff. If Europe is desiring growth and is desiring innovation and is desiring more output along with Asia, along with North America, if these countries can get into that mindset, then it's just better for consumers. It's better for everyone because there's just more options. And we're not solely dependent on, this is, we're seeing the problem the world got itself into when it was solely dependent on the U.S. to always make the right policy decisions. And even if you the Trump discussion notwithstanding, at some point it was inevitable that someone was going to come in and make a policy decision in the U.S. where it wasn't going to benefit the whole world. And this should be a wake-up call, and I think it is. I really think it is. I think this bodes well for the rest of the world as a whole. So this dovetails. Ty, if you had a point on that, jump back in.
No, it's I can't remember what Steve Keen was saying in one of his articles, but it's the curse of having the world's reserve currency. It's not a blessing, right? In the long term, it does become a curse. And it's ironic, right? Trump's he's trying to get to it in the wrong way. He wants to have domestic manufacturing. He wants the U.S. to be adding value to the world, not the rest of the world adding value and the U.S. buying that value, which he calls a ripoff or whatever. But the way he's going about it is driving other, like Europe, if they do follow through with the plans of massive investment because of a threat to their east, they're going to be able to start creating value for themselves again, right? It's just going to be really good. It's going to be good for all the nations that trade with them because they'll be producing value. Yeah. Right. Yeah. And of course, that's like you said, that's, the U.S. is going to want to keep up. So it's kind of going to be a backwards, result for Trump if it, all plays out, right? Where the U.S. says, OK, well, I've got to add value to the planet, too, because I got to keep up here. Or we're a declining empire, essentially, economically. So, it'll drive the U.S., to be domestically independent. But of course, when you start creating all that massive, value added for yourselves, you're going to have surplus. And of course, you're going to create opportunities to sell that abroad, right? So it's going to be good for the whole world to just grow. Every part of the world, not just, have the U.S., in the current situation, it's China makes the value added stuff, and the U.S. drives a monetary policy. Essentially, it drives, monetary policy for the whole world because the U.S. dollar is used across the world, right? And it's kind of that bipolar setup. It's not good for the whole world, right? And if one fails, it's really bad. If China stops creating all that value added, like real value added, we're in trouble. We don't have toilet paper anymore. If the U.S. messes up monetary policy, right, it's a financial crisis on a global scale, right? So the ability for every region of the world to start adding value brings stability to the planet, right? So it's I completely agree in that regard.
I'm looking up, when was the CHIPS Act passed? August 9th, 2022. creating helpful incentives to produce semiconductors in science. Ty, you had mentioned something when you were talking there where if this is a great irony, is if Trump really, and you know, we had mentioned this again even before the whole tariff thing played out, if Trump really wanted to kick off an investment boom in the U.S. to produce more, to be a manufacturing powerhouse, which I'm all for. Like I'm not like against the U.S. having more manufacturing. I don't think it's necessarily necessary to do that, but if that is, let me rephrase that. It's not the argument that I'm making that we have to do that, but if it is what America wants, you know, we had a president not too long ago do exactly that by investing, right? We saw a massive boom in investment when the CHIP Act passed with regards to manufacturing in the technology space, and it goes to show the overall macroeconomic theory that post-Keynesian and MMTers kind of build from, which is it's investment that causes the savings, and the financial savings is the net result, but the real result is the crap that gets created because of that investment, and that investment can always happen because money is endogenous. And that is the key, is that money, that endogenous money grows because income is being added to the system as a reward for investing, right? So in other words, the profits get added exogenously via government spending, then the endogenous cycle kicks off. And the reason the endogenous cycle kicks off is the reward, the profit is being added via government spending. And so if you want to kick off a manufacturing boom, you do that by spending, not by cutting spending, not by tariffs. You're going to get the exact opposite outcome. Yeah, I mean, again, as I mentioned a while back, I like George Robertson's take on this. He's had a lot of wisdom throughout this entire kind of initial 100-day debacle scenario with the tariffs, and that is that ultimately, and I think this is true. I mean, I think it's just going to end up being shown to be true, is that it's difficult to be a politician, and it's difficult to actually pass policy and get political agreement, and that, you know, Trump is right on this point, that the deep state is deep in that sense, and that the courts are going to get in the way of a lot of this, and he's going to be kind of a lame duck president. And if that is the case, then it really is going to be back to kind of corporate America running the show. And if that is the case, then we still will likely end up seeing that investment. So, yeah. I want to, and Ty, if there's anything else you wanted to add to that, I want to jump ship just a little bit. And one of the things I want to do on season 5 of the live stream is start to address or just kind of respond to some tweets, and we'll do that for the last couple minutes here as the stream goes on. Tweet number 1 is Bob Elliott. Bob E Unlimited feels eerily similar to May 2008, and I can't disagree more. You know, from our framework, again, the two most important things are going to be the spending cycle, right? But where is each income generating cycle at? And in 2008, in May of 2008, you had just seen about 4 or 5 year long credit cycle following the 2000.com bubble burst, play out, peak, and start to roll over. You also saw government spending flatline as well. And like I said, you were at late cycle, and private debt was as high as it had ever been. So I'll pull up each one of those. Private debt in Q2 2008, 171% private debt to GDP, and rising into that point, right? We are currently at 145% private debt to GDP, and it had been falling since the post-COVID era, in part due to really what you would call kind of like a beautiful deleveraging, right? We were able to deleverage not in catastrophe like we did in 2008. We were able to deleverage because the public sector levered up so much, right? The spending came from the public sector. So there was that. When you look at government spending in 2008, in real terms, we were right off the back of essentially in surplus, right? The rate of change in government spending had fallen as we were heading in 2008. By the time 2008 really, crap hit the fan, spending really started to take off. But we had just had this surplus, this in real terms, kind of surplus or slowdown in credit creation. And then the final bit on this is if we just use loans and leases as a proxy for all of credit as well. And we look at 2008, we had this acceleration into 2008 before it then completely collapsed. We haven't seen that acceleration play out yet, right? We're still from that massive deceleration following the 2022 boom that played out. And I think we are on the exact opposite page of what 2008 is. Now, Ty, you made a good point. One way we could get to just a bad next 5 years is if companies just choose not to grow, right? But where we are not is at the top of a massive credit bubble that's about to burst. And he qualifies that comment, so maybe that's not what he meant. But where we are not is in a massive credit bubble right now. Might take 3 years to get there and we could be there, but that's not where we're at this point.
Yeah, 100% agree. Right now, it does not feel like 2008. The conditions are completely reversed, right? 2008 was an issue of private debt ratios being extremely high. And meanwhile, public or government debt ratios being really low. And why private debt ratios, why 2008 wasn't the Great Depression of the 1930s is because we saw a massive increase in government spending during that crisis, right? And there's a lot of parts of it that were not done well, like QE, right? But ultimately, government spent into the economy, right? It leveraged up, and private sector debt, it petered off in the 2010s. And same thing with COVID, right? It's not even remotely the same situations, the same dynamics. It's just clickbait for people to say, oh, it feels like 2008 all over again. It's clickbait.
Well, it worked. 700,000 views.
Yeah, maybe those are the tweets. I'm just going to have to start really pissing off all my 6,500 followers and just start putting out bullshit tweets like that because
Bob's I disagree with him. Bob's a lot in terms of how he views things, but he's not genuinely a clickbaiter. I think he honestly feels like something's up. I also think he's just honestly wrong. All right.
I don't know what's worse, him actually believing in what he's saying or him just clickbaiting. I don't know which one's worse, but they're both wrong either way.
Yeah. I agree. Let me see. Don't take this so literally. In May 28, equities rallied on hopes that the housing problems were contained despite rapid deterioration of the service. Different cause today, but the same kind of view that it's over in stocks when the real economy is weakening quickly. I don't know. Look, there's going to be some bad data, like the manufacturing data that came out that's going to look really, really nasty.
Things can be bad over the next 2 years, but the dynamics of it structurally in the economy are completely different from 2008.
Exactly.
So if you were to try to base some mental models off 2008, the results from your mental model are going to be wrong because that's not structurally what's occurring in the economy now compared to then.
All right, the next one, my favorite. And this will actually tie in a little bit to the discussion tonight. I think it's something that I've been studying and thinking a lot about, and it all has to do with money. I mean, a lot of things we've been talking about, money, investment, and that whole argument. Bob Murphy, my favorite Austrian economist. We've had a few chats in the past, both on Twitter, on his podcast as well, put out a call to myself, Ty, and a couple others to analyze his takedown of Randall Wray. And most of this video had to do with the idea of like what money is, what Randall Ray says money is, where money comes from, right? It was more of like a definitional debate, which is fine to have. I don't care. It doesn't bother me if anthropologists one day actually do find this idea that like, no, money really started off is some apes finding a shiny rock and saying like, I'll trade this for you. And then eventually it expanded to something else. Fine. Regardless of any of those discussions, the fact of the matter is, and this is, my big point, is today we have a monetary capitalist economy, and the economic system that we're trying to develop. And this is the other point. I'm just gonna back up. Economics, to me, personally, I don't care about it at all if it's not going to give me any ability to understand how to forecast future outcomes, right? Like, listen, everyone listens to space podcasts, physics podcasts that just make you go, wow, the universe is big and there's so much to understand. Knock yourself out. That stuff is a ton of fun. It becomes philosophical, and we can all have the college dorm room, while we're smoking weed, debates about the philosophical leanings of various economic thoughts, like we all do or did when it comes to how big the universe is and all that sort of stuff. To me, for what it is, especially what we're trying to do here, and where I think the payoff is what can your economics forecast? If it can't forecast anything, it doesn't matter. I mean, it maybe it does to someone, but if it can't actually forecast any outcome, it doesn't really matter. And the reason I make that tangent is that, what we've done, and I think we've proven out over the years we've been doing this, is our economic framework can forecast something. And so regardless of how you think money came about and whether or not your assessment of 1850s Virginia's use of, or 1750s Virginia use of some stick as a tax or not, I forget the exact story, is beside the point, because for better or worse today, we are in a monetary capitalist economy. And what that means is that money is definitionally what Randall Ray was explaining it to be. That money gets created, and money is a operation that's going to occur on a balance sheet, and that money is a financial asset. And that means that balance sheet operations, and I had this tweet pulled up as well, where a guy that I at least respect, Bob, because he's a nice guy and fun to banter with, but our not so good buddy Per Bylan is trying to take a shot at people who are wanting to do accounting with their economics, and that betrays some lack of understanding. Again, this is another guy that for the last how many years has been calling for a crash in the economy, just like Bob has been. Bob and I's conversation was 2 years ago now. 2 years ago now, on his podcast. And I mean, you just go listen to it, and Bob is calling for a crash, inverted yield curve, right? None of that ever came about. And so it's, to me, the reason accounting matters is because we have a financial economy. We have a financial economy, and that means something. That means that, is it true that you could have a world that exists and does exist where investment means that you are Minecrafting something, right? You go out, you cut down a tree, you use your time, you are creating savings that you're going to use to then create something else. So you cut down a tree, you fashion an axe, you use that axe to then cut some cobblestone, then you mine, cobblestone axe, and then you get to cut some silver ingot or some ingot and iron ingot. Now you have an iron axe, and now you can go mine some diamond. Is that Minecraft example potentially true? Yeah. But what's also true, and then the profit for the private sector is then the addition of the real assets. Yeah. That is undoubtedly one facet of this that is not incorrect, right? But what is also true is that money is endogenous. It is a financial asset. It can be created. And when it is via investment, it becomes net savings. It also becomes and is also the profit for the very investment that needed to happen based on those profit expectations. And that is what is missing here. And that is why, going to Per's point, accounting matters and why you can tell so much, right? It's not accounting for accounting's sake. It is the way in which you can see the actual causal chain of events playing out. You can see it in the balance sheets through time. It's not a static balance sheet. Let's see what this thing says. It's the rate of change of the various stocks over time that actually tell you the picture. And that is why it's so important. That is why I went hard at him on this specific issue of no, where you're getting this wrong is this idea that really it's savings that creates investment. And it's a quick throwaway line a couple times in that video, but the whole argument we're having here on our side of things and why I think it points to why we've been so successful in our forecast is because it's the other way around. And it's the other way around because, and they can't understand this because they get what money is in a monetary capitalist economy wrong. So Ty, I can see you wanting to jump in. I know you have a lot to say on this, so I'm going to let you rip.
Well, okay. Well, geez, there's a lot to unpack. For one, that specific interaction, yeah, I did not actually watch Bob's video because I didn't care. I don't like you. I don't care. This is going to, this is why I kind of attack Austrian Economics so much, because it's just a bunch of stories, right? I can't create a forecast out of any of their theories, really. Maybe some basic behavioral assumptions about malinvestment, but I have to start from scratch anyways from there anyways. It doesn't give me anything. But that applies to the whole argument. That includes MMTs, the chartless argument about, I don't care about either side of, what was created 5,000 years ago or what is happening now, right? And I find it ironic that Per or Pi or whatever his name is, calls himself an accountant, but meanwhile says counting's not important. But that's what you do in economics, you count things. So I find that really bizarre. And I go back and I'm more interested, Doug, what you said, right? Like, what's the point of all this if you can't make projections in the future? So imagine, this is why economists shouldn't be academics. They should be professionals, like doctors. You go to the doctor and you say, I've got a pain in my chest. And the doctor's like, well, the origin of your wisdom teeth and why they fall out is because back in the day, we didn't brush our teeth. So we speculate that as one of your other molars fall out, the wisdom tooth comes in and you can chew food. And that's a great story. And of course, another doctor's like, well, we don't really know that. Wisdom tooth is just when we had bigger jaws when we were Neanderthals, so we needed more molar teeth, right? And then it comes back to what you're trying to forecast, your heart condition, because you're about to die from a heart attack, and all everybody's got is stories, right? So I found it interesting, Doug, you sponsoring all that. It's very correct, and it's I maybe sometimes even with my own followers, I have a hard time interacting because I don't look at stories and history so much. I look at it, what is now? What is the system now? And how is it going to evolve dynamically going forward? So that's my comment on that, not so much on the gritty details. And I couldn't qualify it with a real response because, to be honest, I love Bob. Okay, between Bob and Per, Bob's a great guy. I could sit and have a beer with that guy, but I'm not going to sit and watch many of his videos because it's story Austrian driven and doesn't really mean a lot to me making forecasts.
Yes, I agree. Forecasts are where it's at. Yeah, I'm not, and that's not to say I've really enjoyed. I've never read the book all the way through, but I've really enjoyed like David Graeber's talks that he's given on debt, and I think it's really helpful. I think what's really helpful about like understanding money. And actually, I mean, the conversation Bob had at the end of his video, he spent about 30 minutes on, I forget what it's called, this something that happened in Virginia 200 years ago with money. It was interesting, in the sense of, again, like a podcast about physics is interesting to me, even though it's not necessarily applicable to my day in and day out life. So it's not that isn't important. I think what it does do, though, is it gives you the framework necessary to understand that money is much broader than just an evolution from barter to a consistent intermediation between two people through a single intermediating barter good, and that money gets created on balance sheets. And when you understand that, you can take it's really, I hate to keep beating this dead horse, but it unlocks the ability to make accurate forecasts because you can actually measure the variables as they change over time in a macro economy. So go ahead, Ted.
I think really too, and this is where we, me and you and, Adam, if he, some people might know Adam here, we are really trying to take a very large approach. We're not just looking at money. We're looking at value added, real stuff being created. We're melding the two. So like when you see that the academic debates on X and elsewhere on social media is usually a viewpoint from just value added, which is Austrian, right, is what's being made, right? And how do you make it? And some Austrians still believe that you can save a loaf of bread and then build a factory out of that loaf of bread. It's far more complex than that, but they're really focused on what value is being added to the economy. MMT, very rightly so, says, look at all these balance sheets. We should be tracking the money, right? Not asking where the money's coming from, but just look at it on balance sheets, right? And sometimes you can get just trapped in that thinking. And, here, in modern macro technologies, we're melding them both. We're looking at, how can you manipulate the balance sheets or look at the balance sheets to see how value is being created in the economy, which of course leads to real variables like employment, et cetera, et cetera. And then how does that feed back into, banks providing credit or decisions by politicians to either, deficit spend more or tax less, spend more or spend less, right? And it can be overwhelming, right? But you have to kind of do all those things and accept those things right now as a system to forecast, right? And stories 5,000 years ago, and I like David Graeber too, and I think his argument is more compelling than some of the papers I've been shown by Bob and Pear.
Yeah.
I think his argument's more compelling, but it doesn't really, it's interesting, but it doesn't help me right now forecast. And that's what people want, right? Ultimately, at the end of the day, if you ask any layman on the street, what does an economist do? Well, he tells me what's happening in the economy and what's going to happen down the road. That's what an economist, right? And framing it any other way, then okay, you're an historian, right? If you really like the historical stuff, and that has a place. We need to understand, where our world was and where it's going, right? Or you're an Austrian economist, and in that case, maybe you should just be a philosopher. And Socrates wrote a lot of cool stuff, and you can start quoting Socrates, right? But what I'm interested in, I know what Doug's interested in, we're looking at forecasts. What is the economy? How does it structurally work, and what's going to happen going forward so people can make better decisions going forward? I went on a rant there. I'm sorry.
That was good. All right. Seeing a couple questions. Django Geek, help me out if I'm not getting the full point of this question. Net government transfers seem to be trending lower, commensurate with the increase in bank credit. So government spending's lowering relative to the increase in bank credit. Once we get a spending bill from Congress, is the bottom in? I assume you mean the bottom in with where the market is at? Is that what you mean by the bottom in? And if that is it, even if the spending, the market, even if the spending bill doesn't go through, I still think, or go through as aggressive as it looks like right now, and spending doesn't really take off, I actually think markets can still continue to push higher. I mean, I've been thinking that no matter what, markets push higher. So, and we saw this. I mean, again, we saw this in the late 90s. You can absolutely get flat government to surplus spending situation and still get push higher in equities because of massively increasing credit. And I think that's what we're seeing now. If a massive spending bill gets pushed through, then yeah. Even a bigger rip, I guess, right? And there might not be a bust. There might not be a big bust at the end of it. On that point, one qualification that I will put out there is yeah, and I should have had this at the outset. One qualification I'll have out there that can really kind of change my overall view on things is monetary capitalist economies like the U.S. operate on profit expectations, right? People are willing to invest money. They're willing to take out debt. Banks create debt because they expect profits based on, whatever good or service is being created, whatever value add is being created is actually going to be profitable, right? And so that is, it all revolves around profits. That is the most important thing to a capitalist economy, is what is the profit expectation? If you remove that profit expectation, this is one of the things that ticked me off in Bob's video and that ticked me off in some of the comments, is they will say, one of the things that Randall Ray rightly pointed out is is that the biggest spenders over the last 20 years, the biggest budget spenders in capitalist economies, have also had the best economic outcomes. The U.S. being the main example of that, and Europe being the main example of countries that haven't spent, right? So and Bob quickly then pointed out, well, look, East Germany and North Korea have spent a ton, but the outcome for them wasn't that well. Yeah, they're not capitalist economies. It's not about a profit motive that is driving investment. It's about, can I bribe political leaders, right? Can I get favor with political leaders? Now, my point is, if that becomes the motive for success, if business success is dependent on political favors, then that kills capitalism, right? You're no longer in a capitalist economy if loans are being created not on the basis of, hey, is this thing going to be profitable? If it's, can I have favor with the leader of the country that's going to essentially then grant me success. If that happens, and I have to put it on the table based on everything that I've seen, that is a potential here, and that breaks down the capitalist order. And it does get under my skin. I'll be honest. It gets under my skin when people say, MMTers or post-Keynesians aren't capitalists. No, I am very much a capitalist, and I love everything about capitalism, in the sense of I want the risk to be rewarded, and that the game that we're playing is the ability to make profits because we're making products or services that benefit society that people want to pay for, versus products and services that they choose not to pay for, right? And there is an emergent property in society called government, where government can really take on the effective risk of creating new money at the expense of the failure that will happen in that endeavor to take on the losses so the private sector can get all the benefit from it, right? And I mean, that is the essence of kind of what the post-Keynesian MMTers are trying to say, and that emergent property is government. And so you can still have a government that spends a lot and that is very, very capitalist. And that is exactly what the U.S. is. And what makes an economy capitalist is the profit motive, because it is the creation of new investment that creates the savings that we see as both financial savings and real savings in the sense of actual created value added. That is the outcome of that. And when you go to countries that are not capitalist systems, you are not going to get a similar outcome. And it's not too difficult to switch from a capitalist to non-capitalist system if you just change the rules that win the game. And the main rule right now is, you're going to make a profit if you make a better product. And so it's worth taking out the loan. It's worth the bank risking it to create that loan for you. Okay. If you have anything, Ty, jump on in. I have one more question here. Michael. Yeah, we are live. Thanks for jumping on and saying hi.
Michael D'Souza Cruz is in the house.
Still one of the best YouTube channels out there, where he MMT, ABCs of MMT. I think that's what it is. Literally, if you want like all the like Mosler books are on there. He reads through them all. It's great. Um, Put in chat, Michael, what the actual site is. Sorry, man, I probably got that wrong. This final question I had was, why isn't credit forgery? MMT dude on Substack was ranting against endogenous money today. And I looked him up. I can't see ABCs of MMT. I can't see. I looked up the name, this Jim Byron, real quick, and I can't see his article. But as Django Geek rightfully pointed out, banks have a charter. So, this is one of the things, like I think Mosler makes this point, where he essentially equates or says that banks are government agents, right? Because the government is setting, they're chartering the banks, they're allowing the banks to create the government unit of money, and they are also setting the rules for which that money can be created, right? So I'd have to see. I mean, maybe the guy's point is the government should just do all the money creating directly, and that not leave it up to the private sector. And again, that's something that I just would be against. I mean,
I would be too if I had this discussion, and our buddy Steve Keen is against that too. Again, we like capitalism, right? There's ills to it, but I like to be able to shop around for where I store my digits and where I'm going to purchase financial products, right? I don't want, for instance, could be the central bank just being your only bank. That is draconian in a lot of respects. And as for, you can call commercial banks agents of the government. I've never been a fan of that myself. If as a truck driver, you have to get your national safety code for your truck. If you own the truck, you have to get a driver's license. You have to drive on government roads. They can be considered agents of the government too. At the end of the day, it doesn't really matter. They're in it for one reason only, and that's the motive for profit. So it's just a story, again, going back to the things that I don't really care about, right, is the bottom line there. Banks, commercial banks, whether you say they're a derivative of the government or not, at the end of the day, their main purpose as a corporation that exists is to get profits, and that is their motive.
Yeah, and I think the outcomes are better in a world in which there is private demand for money creation via investment. And Django Geek said the money supply, it's better this way. The money supply is demand driven, which I concur. Okay, that's my thought. I'd have to see the actual article. Like I said, I couldn't find it on his blog or anything, so maybe he was on Twitter. All right, crew. Chat, it was great to be back, and we'll get these up and running again. Might have to switch the day from Monday to somewhere else. I don't know. We'll see, but we'll be back weekly.
Doug doesn't know it yet, but we're going to be doing a lot more of these.
Yeah,
we're going to be doing a lot of these. Whether Doug shows up or not, I'll do them on my YouTube channel too, because I've been lacking. Both Doug and I have been busy actually building some really cool things that we'll talk about in the next stream, I'm sure. But we're gonna, make more appearances. Say hello to all our friends, like Thomas D. Geez, I've been seeing you on these YouTube channels now for 3 years, 4 years, whether it's the Steve Keen channel or here or on my channel commenting. Same with Django Geek. See you everywhere. Michael D'Souza Cruz. So it's always good seeing you guys. You're kind of like extended family, right? Distant cousins that we see at family reunions every once in a while. I might not stand in front of a car for you, but I care about that you're doing okay in life. So it's good to see you guys.
I assume the car was moving that you wouldn't stand in front of.
Oh, definitely, yeah.
Okay,
I've got some second cousins out there that not a chance. I've got too much to live for.
What was I gonna say? Yeah. We have. I was so close to having the one thing implemented, but I wanted to show some of it off. But we have I'll give you guys this hint. I'll give you this teaser. We've completely reworked what was Deep MMT2. We're now calling it Deep Minsky. It is a Herculean project of epic proportion, where we have in our building out, and we have kind of version 1 of it completed, where we have defined every entry in the Z1 tables for the macroeconomy in a system dynamic in a system dynamic framework that is what Ty originally built out as his national model. So it is a massive endeavor. I guess the best way to put it is we have created the first ever fully empirical, fully endogenous simulation of the macroeconomy using all the empirical data. And it's when it's all said and done, it's going to have hundreds of table entries in terms of the underlying stocks that we are going to be tracking. It's been, I don't want to sound too much like Elon Musk here, but it really is massive, and it's been a ton of fun. It's been a hell of an effort to get it all done. We've had some really good outside help as well as we think through this, and it is I'm excited to show it. It really is the way that, and it's important to, God, I should have had this. Go ahead, Ty. Talk for a second.
I was just the Django geek Z1 table, and this is something. So we've had, as Doug said, outside help, and I've used Fred for years, but and I knew about the Z1 table in passing. But essentially, it's just a catalog of all the data sets organized in different manners. So you can really start to build at least a stock flow consistent model out of it all. So anyways, so just looking at the Z1 table, there's one part in it called integrated macroeconomic variables, et cetera, right? And so it is really like a look at the macroeconomy from the Fred database, right? It's organized well, right? Well, we want to represent all those variables, how they change dynamically over time, right? Not just the static picture that you get out of Fred, right? So that's what the Z1 table is, just an organization of the Fred data. And I've used it now for a few months, and I thought, how have I lived without this my whole life? And one of our internal friends really has clued us, well, me specifically, I'm sure Doug's used it, but I didn't use it enough. And I'm addicted to it now. Like, you can drill down in deep, kind of below the macro level, and find individual sectors and industries and really get the answers you want. You got to work for it, but it's incredible geeky stuff that I love. And also, Michael, why aren't you on Twitter X anymore? I never see you on there. I see you on my YouTube commenting on the quotes and stuff, but you should show up on X, right? You should see all the amazing comments I get on those quotes, where I get like thousands of likes and hundreds of hate comments, basically saying I should die. Come support me there.
Speaking of models, and speaking about this being an endogenous model, I had this come up where I do love the outcry of you just posting a simple quote and people losing their minds over this simple quote, as though you're the one saying it. I'm literally attacked. I've had like quasi pseudo threats made towards me and my family members at points. What's wild, I mean, that's like going to a librarian and being like, did you see what this book said?
Good times.
How dare you? Librarian. Going back on the entire, I want to make sure this is clear too. I'm sure everyone who's made it to this far into the videos is well aware of this, but I want to be very clear that the models we are building are fully endogenous. And it's probably an important thing to talk about. The vast majority of models that are built, economics that are built, are very kind of econometric in the way in which they are developed, right? And all that means is an econometric approach is effectively like you're effectively doing kind of regression analysis on different variables to determine relationships that are out there. And I don't mind doing that as a first step, right? Look at the data, see if there's a correlation. And a correlation, I mean, if you have an underlying theory that makes sense as to why they're correlated, can actually be enough evidence to determine causality. That's fine, right? Like I'm even fine with all those steps. But the point is that there is a limit to what you should glean in the value of econometrics, what you should glean out of something like that and the actual value of them, particularly the value for forecasting. Because in reality, the macroeconomy is not a linear system. And even if you use econometrics where you're assuming nonlinearity, unless you're actually baking in as endogenously define stocks and flows, what that endogeneity looks like over time, because you're defining the proper functions of how various inputs are interacting with each other. So even if you do an econometrics that assumes a non-linear type system, you're still relying on essentially fitting the past and assuming that that's going to play forward in the future. And the reason that that comes up a little short is every system state is going to be different enough where the outcomes into the future are going to be different because of the way system dynamics plays out and the way that initial conditions will always change an outcome, and it can happen very fast, right? I mean, it can, the outcomes can vary down the line, or it can happen in a very quick manner. And so the point is, the entire model that we're building is all endogenous. There is the only sort of econometrics that we're using is when you do fit the various curves of the functions, you are having to make some assumptions based on historical relationships, but that's not econometrics, right? I mean, we're defining certain features, and we're actually developing ways to get around even that. I mean, to broaden the potential there and to get a better picture of that using some deep learning capacity at those junctures. So it is fully endogenous. Suffice to say, what that means is, we're going out and grabbing the data that is available in the Z1 data and using the model based on that data to then project forward. And the big leap here is it's empirical, right? That is the big leap where the model that we had, both the model that Ty created, that he called his national model, what I originally created with DeepMMT, the national model was not empirical. DeepMMT was still what I would call closer to an econometric, even though I had some dynamic stuff in it, was close to econometric, whereas what we're now evolving into Deep Minsky is purely endogenous, meaning no one's even freaking close. No one's even freaking close to what Deep Minsky is going to be. Can't wait to get there. Jump in, Ty. Say a few things. This is another question I want to touch on before we take off.
Yeah, it's definitely nothing's been done. You kind of summed it up. It's an endogenous model, right? So linear modeling, and we'll just keep it linear regression, right? So you're looking at a relationship between two things and dot plotting and putting a line through it. And so you could just project that line will go into the future infinitely or go negative infinitely, right? And calibrating those models are extremely easy. And so long as there's no shocks in the economy, they can be really, really accurate, and they have a place for them. We utilize doing that, but just for our behavioral functions. We'll look at really strong relationships that we know exist, right? And we, of course, won't use linear relationships. So we'll use exponentials or sigmoids, logistics, et cetera, et cetera. But then we don't just stop there. We feed ratios, behavioral ratios into those equations. It gives us an output, and then we use those as multipliers, right? But the big thing in system dynamics that differs from like DSGE models, right, is we have stocks, right? So stocks are accumulation. So they contain numbered information. They go up. They retain things that have happened in the model in the past, right? And you start multiplying all those equations together using some sophisticated formulas, you start getting nonlinear behavior. And so you can look at the best DESG model on the planet, one of the best out of the Fred, and they predict zero inflation during the pandemic, whereas our nonlinear model
zero inflation in the post-pandemic, is what he meant to say.
Yeah. And in the post-pandemic, just flat line 1% or 2%. I can't remember what the data said all the way through. And of course, as the new data comes in, they just shock the inflation data upwards. So you just see a step up and they're like, okay, but inflation, and they show it coming back down. Like I posted this 6 months ago, right? And so that's the difficulty with those models is once you have a shock to the system, those linear and even sometimes small exponential functions, those regressions, they don't hold anymore, right? It would be like a meteorologist saying, well, the clouds are moving this way. As the wind blows this way, I might as well just draw a line through it. And the forecast, the wind's always going to be blowing east to west, and the clouds will move east to west. And that's your forecast for eternity, right? Obviously, that's not the reality. Weather is a complex system, just as the economy is.
A couple good questions here. How is reaching the debt limit or no new treasuries affecting the model as of right now? And then I'll also maybe tie this into Nicholas Gomez's question as well. But let me make sure that's up on screen. How does reaching the debt limit and no new treasuries affect? Are they affecting the model at this point? Kind of version 1 of what we're calling deep Minsky won't have that robust of a banking sector at this point where we could model something like that out. And the goal out of the gate for Deep Minsky, and I think someone also said earlier, what's the goal with this overall project? Who's going to use it? I mean, our goal is to really inform a kind of macro hedge fund strategy framework, in the sense of the idea is to really help us understand in a cyclical kind of dynamic economy where we're at. And I can actually pull this up. I don't think there's anything on screen here that is something I don't want to show. Give me 1 second. Let me double check. Yeah, we'll just show it. Some notes here are just a few kind of mental models for how to think through like a positioning, kind of a macro positioning framework, and where we see a tremendous amount of value immediately, even for the version that we have, which is this idea of kind of whether you can look at it like a macro cycle from like a leveraging to deleveraging type of standpoint, or like a growth and inflation type of standpoint, and the concept here then is, you can have let's say what we've seen in the treasury market, what we've seen in stocks is in part because of the debt ceiling, right? Let's just accept that was part of the case. And our argument had been that we were we were heading into a rising growth, rising inflation environment where things like commodities, things like stocks that had been really beaten up over the last 15 years were going to maybe start to win out, that sort of environment, right? And that's where we were headed. And then all of a sudden, we started pricing in things where we saw stocks collapse. I mean, we actually went into a world that is very rarely this very rarely seen, where we saw stocks collapse, the dollar collapse. We even saw bonds go a little wonky for a little while. So we went into kind of no man's land from a quadrant standpoint, right? But the expectation was up here, and so to us, we saw this big mispricing in a different direction, and then where our model steps in and says, okay, based on the way the data continues to play out, the move in the market was actually mispriced, right? In other words, we want to be against the market right now based on that, as opposed to continuing to follow towards the market. And you can see that, same idea play out from a way in which you would move from like an income and debt perspective, right? Where back in, say, from 2022, which would have been kind of the bottom of the most recent kind of disinflationary environment, up to the buildup that we've seen where leveraging starts to play out to today, and where income growth is also increasing. So GDP and that income growth is also happening via, higher government spending, that we're seeing this, more beautiful leveraging. And this allows us to know where should we be positioned, where should we be leaning. And so we don't necessarily need, at this point with these sort of strategies, to be able to to add in the dynamics on the very short run, because we can just simply say, okay, well, the alpha generated here to get long or remain long in a sell-off gets us in the right situation. So that is one, that's kind of how we're looking at it. And then to add into that, you can't know all the variables. Never mind how they interact. I don't disagree. Obviously, there's, especially when you start to get into individual actors and how they're going to play out on a micro level. There are ways in which I think you can model that to where you can get the probability of a given outcome. You can do, and what the plan down the line for, once we get the full model built beyond even the initial version that we'll get demonstrating soon, would be to add in a layer of agent-based modeling and taking some kind of theory of how agents operate, and allowing kind of like an evolutionary algorithm to produce multiple outcomes based on the macro model, and that can then give you kind of a spectrum of potential outcomes. And so you can, obviously you can never know what path you're going to take, but you can get a probability of paths that things could go down. But going to the overall idea here, to kind of interact with this comment, this point, the more you can define in terms of the various interactions, the more you can use the empirical data to then allow the nonlinearities and the complexity of the system in a system dynamic model to help you find those emergent properties. And this is really what's key, is to help you find those emergent properties that are likely to emerge that you wouldn't have known otherwise, right? And see them in real time. And that is really, for a lack of a better way of saying it, well, actually, no, it is the right way of saying it. It is really the alpha, if you will, that we think we're attempting to generate specifically with building out these system dynamic models. Now, obviously, the cone of uncertainty is going to remain large, and the idea is to trim that down with better and better theory. So your point, I'm not disagreeing with your point that we're never going to know everything, but I think there is a value add to jump from. And Nick, I don't think you're saying don't jump to from econometrics to system dynamics, but I think there is a significant jump forward to system dynamics.
We got to also too, it's very important to differentiate micro and macro, right? So like the reason we do macro, and I'm not talking from an economic literature standpoint, but like from a system dynamic standpoint, is we're looking at the system as a whole, so the great parts of it, right? And so it's like akinning it to, we're not measuring how particles shift and or it can shift from one area to the next. So we're not modeling that. We're just looking at the arm itself, right? And we know the arm goes like this, and if a force like this stops it, we know it goes like this, right? And we can measure that over time and create functions. So we're measuring the greater parts. We're not measuring every little micro variable. As you said, that's impossible. But we can measure things like gross capital investment. We can measure things like non-corporate profits, or corporate profits, right? We have those aggregated pieces of data. We can look at how those that data interacts over time, right? And we just see the large parts of the system. Well, Doug did hit on the nail there, and some researchers in other fields have been doing that, is that they've been creating large dynamic models, right? Getting outputs and then applying agent-based modeling to drill down and look at the micro. And of course, agent-based modeling is where you build the assumptions of the behavior, and you see a bunch of little agents interacting together. So it's basically agent-based modeling is for the micro, and system dynamic modeling is for the macro. And agreed, even in macroeconomics, we can't know all of the variables. But we can kind of categorize all the large components and see how they behave over time, develop functions, and then create nonlinear models to kind of see what emergent behaviors come into play.
Nick, your point absolutely stands about the sudden disconnect between where flows have been to where markets have been in terms of the pricing, and then that the fundamental driver is the current administration. And you might not have been here when I was qualifying everything that I'm saying with, capitalism operates on profit expectations, not on can I bribe political officials, and it obviously if the ability to bribe political officials is what's going to drive future growth, which certainly that there is a case to be made, in which case then you're absolutely right. Our models become very difficult to project, at least in the U.S. But yeah, I've definitely been looking into kind of European data and that sort of thing as well, just because it is. At the end of the day, my guess here is still that it's kind of like when you get insurgencies that take over in nations. Is the word that probably fits better than an insurgency, but I don't want this video to get demonetized. And then it's like, well, you just won the war, but now you gotta, now you gotta politic, right? Now you gotta actually govern, and sometimes it's very difficult to govern. So the trick is to govern, even if you are trying to essentially just do everything by dictate. And I think at the end of the day, if it can't pan out the way that the Trump administration wants it to pan out, that for better or worse, corporate America wins out, and we get the sort of outcomes where once again flows remain the predominant driver. So I think those are my final thoughts. Ty, anything else before we take off here?
No, nothing else. I just, was anybody disturbed by this light? I asked at the beginning of the stream, but there was less people here. Does it bother you? I like it. I like how it just kind of transitions, and it's a little fast, this part. I like it when it does like the slow transition up and down. But yeah, if anybody doesn't like it, let me know, and then I won't use it anymore. But if I'm not getting much feedback on it, it just seems like
Ty, I hate to be the bearer of bad news, but I got tons of DMs in Twitter.
Yeah,
telling me.
Well, Twitter, trust me.
Tons of DMs telling me, yeah, the light's too distracting.
Yeah, well, I get tons of DMs literally people telling me I should die. So like, it is what it is with Twitter. I'm just talking to the people that are actually tuning in and watching us. Essentially.
All right. Well, people are saying they like it, so I guess that's what I thought. I guess I'm stuck looking at it. All right. Great to be back, everyone. Chat, thanks for. RGB makes GDP go up. Hey man, if that's what it's going to take, we'll keep the RGB coming. All right, everyone. Thanks for tuning in tonight. It was good to be back in the live stream. We will be back on very, very soon. So, subscribe, notification bell, all that sort of stuff. All right, crew, chat, Ty. Have a great night, everyone. We'll talk to you next time. Bye-bye.